The U.S. labor market had an impressive month in April despite surging inflation. U.S. employment rates have continued to increase robustly in the face of the highest inflation in 4 decades. According to the Labor Department, U.S. employers added 428,000 jobs in April. The unemployment rate held steady at 3.6%. On Wednesday, the Federal Reserve raised interest rates by half a percentage point as it tries to tamp down rising prices. But Wall Street is still worried about how much the Fed can do to bring down inflation. Those concerns made for a very volatile week in the markets. And experts worry about the R word, recession. Joining us is Akane Otani. She is a reporter for the Wall Street Journal, where she covers the U.S. stock market and investing. Akane, it's great to have you here. Let's just start off with talking about inflation. It affects the market by influencing wages, consumer spending, business investments, and interest rates. How are these things tied together?
Well, generally, when we see a rise in inflation, we see the Federal Reserve start to act to try to pull that back to its target level. The Fed likes to see inflation running at about a 2% level, and lately we've been seeing numbers far outshoot that. In fact, the last month reading that we got was around 8.5%, the highest pace in 4 decades. So what we're seeing the Fed do now is raise interest rates and actually raise them faster than a lot of people thought they would at the start of the year in order to try to slow down the economy enough to pull back that inflation.
So I'm curious, what does the April jobs report tell you then about the current state of the economy and the U.S. labor market?
Well, the labor market has been a really bright spot for investors for a long, long time. And the most recent numbers we got continue to show that that trend holds true. We saw employers adding more than 400,000 jobs again, the unemployment rate staying very low, wages growing again. And those are all really good signs. But ironically, that's the type of news that some investors have been a little bit worried about, because they think that's going to show the Fed the labor market is strong enough for them to keep raising interest rates. And the big worry now is, can they really do that without slowing down the economy too much and actually tipping us into recession?
Akane, another good sign. Average hourly earnings increased 0.3% after advancing 0.5% in March. This is the largest increase in more than 3 decades. How is inflation tied to this increase, and will American workers be able to enjoy the fruits of their labor?
Well, unfortunately, on a year-over-year basis, wages didn't actually grow enough necessarily for the average worker to offset what inflation has done to their budgets. So we've seen prices for household goods, for gasoline, for homes, for all sorts of things rise over the past couple of months, and wages haven't been growing quickly enough to keep pace with that. So that's another thing that I think a lot of folks are keeping an eye out for at the moment. Can wages start to actually grow fast enough to meet up with inflation, or can we pull back inflation so consumer spending doesn't eventually get hurt by all of this?
As you know, when we have headlines like we've had in the last few days, a lot of people start to worry about their 401ks and other retirement investments. What should they know?
Well, there's a saying on Wall Street, and it's don't check your 401k. Whenever the markets are really volatile, you start to see people say that. And it's a really good reminder, because these swings are so dramatic from day to day. But when you look at what happens months from now, years from now, your overall portfolio, this may just look like a small dip in it. So really, for the long-term investor, and I think that includes most people who are saving for retirement, it's important, financial advisors say, to keep these types of days in perspective and to not make any drastic solutions or drastic moves. So, no dumping all of your stocks just because the stock market had a bad day. You really want to sort of sit back, digest the news, and wait before deciding to make significant changes.
Such good advice, a good reminder. This is a long game. In your professional opinion, are we heading towards a recession?
Well, I'm no forecaster, but the economists that we talk to have really been saying they're seeing an increasing chance that we do see a recession in the next year or so. So the latest Wall Street Journal survey of economists showed about a 28% chance of a recession within the next 12 months. So that's significantly higher than what we had seen a couple months ago. And a big reason for that, again, is inflation, supply chain disruptions caused by all sorts of things like COVID-19 lockdowns again in China, factories that are still trying to get back to their regular programming. All of that is expected to really sort of start to weigh on corporate earnings in the second half of the year. And of course, economists are also worried about how inflation ends up hurting consumers and their spending. So that's why we're starting to see elevated odds of a recession in the next 12 months. Although that being said, again, with the strong labor market, economists are really seeing that as a good sign. So it's not all doom and gloom yet.
Good, good. There are so many things at play here. Thanks for breaking it all down for us, Akane Otani. Thank you.
Thanks for having me.